I've spent the last 6 videos telling you where not to put your money. Florida, insurance trap. Texas, property tax trap. Tennessee, sales tax hiding in your grocery bag. California, trying to tax you from beyond the state line. Today is different. Today I'm telling you where I am putting mine. There's a region of New York that wealthy investors, Manhattan money managers, and a very quiet group of people who actually understand land value have been calling the New New York. Upstate zip codes, 2 hours from the most expensive real estate market on the planet, still priced like it's 1995. And the window to get in at ground floor, it is open right now. But it is not going to stay open. I'm Benjamin Franklin. This is Finance with Franklin. And today, I'm sharing the map.
Before we get into the zip codes, I want to take 30 seconds to acknowledge something. Last week, we went deep on California's 2026 exit tax, the proposal that would let California chase your wealth even after you've already moved out of the state. If you haven't watched that one, go check it out, because understanding how aggressive some states have gotten about holding on to your money, it actually makes what I'm about to show you land even harder. Because the people moving their capital to upstate New York right now, a lot of them are running the same math we've been running on this channel. They looked at the coast, looked at the tax bill, looked at the cost, and said, I need a smarter play. This is that play.
Here's why this particular region of New York is having its moment, and why I think the moment is still early. Number 1, the remote work permanent shift. COVID didn't just temporarily move people out of cities. It permanently changed where knowledge workers are allowed to live. The percentage of fully remote or hybrid workers in the U.S. is still sitting above 25% at 2026. That's 40 million people whose job doesn't require them to live in a $4,000 a month Manhattan apartment. A significant and growing number of those people are looking 2 hours north of the city, where the air is cleaner, the land is real, and the price per acre still makes sense. Number 2, the infrastructure investment. Amtrak's Empire Service Line runs straight up the Hudson Valley. New York State has put real money into broadband expansion in rural counties over the last 3 years. This isn't a place you have to sacrifice connectivity to afford. Fiber internet in Columbia County, in Ulster County, in the Catskills. The infrastructure argument that used to kill rural investment, it's getting weaker every year. Number 3, the Manhattan money migration. This is the one that really got my attention. In 2023 and 2024, Columbia County, Dutchess County, and Ulster County all recorded the highest percentage of out-of-county buyers in their history. The majority of those buyers came from New York City and its suburbs. These aren't retirees buying a cabin. These are 35 to 50-year-old high earners purchasing primary residences and investment properties, moving their capital from a market where they can't get in to a market where they absolutely can. When the people who manage serious money start quietly buying in the same zip codes, that's not a coincidence. That's a signal.
All right, here are the 4 regions I'm watching, and in some cases already moving on. Region 1, Kingston, Ulster County. Kingston is the one that started the whole conversation. Former state capital of New York, walkable downtown with a genuine arts and food scene, median home price still under $380,000 as of early 2026. But here's the real number. Home values in Kingston appreciated 31% between 2020 and 2025. 31% while remaining accessible. That is the exact combination you're looking for. Region 2, Hudson, Columbia County. Hudson is further along the gentrification curve. Warren Street, the main drag, has become one of the most concentrated strips of antique dealers, boutique restaurants, and design studios in the Northeast. Land in the surrounding Columbia County townships still undervalued relative to what's happening in the city center. If you can get 5 to 20 acres within 15 minutes of Hudson proper, you are buying adjacent to a market that already proved itself. Region 3, the Catskills corridor, specifically Delaware and Sullivan counties. This is the earliest stage play on the list. Delaware and Sullivan counties are where the artists went after they got priced out of Ulster, which is exactly what happened in Brooklyn before it became Brooklyn. Land here is still, and I want to be clear about this, genuinely cheap. Raw land parcels at $2,000 to $5,000 per acre. Short-term rental demand is growing 18% year over year in these counties. The Airbnb and VRBO market here is not saturated. There is still room. Region 4, Beacon, Dutchess County. Beacon is the one that Wall Street already found, but that the general public is still sleeping on. Dia Beacon, one of the most significant contemporary art museums in the entire country, sits here. Main Street has been fully activated, and Beacon sits on the Metro North commuter rail line, meaning it is technically a commutable distance from Manhattan. Real estate in Beacon proper has moved, but the townships surrounding Beacon, Fishkill, East Fishkill, Wappingers Falls, those are still priced at the before Beacon got cool level. Buy the neighborhood next to the neighborhood that already won.
Real talk, because that is always what we do here. Upstate New York has challenges. Property taxes in New York State are among the highest in the country. Before you buy any parcel, run the full tax number. Some counties have meaningful tax abatement programs for agricultural land or conservation easements. Do that research. Seasonal weather is real. Winters in Delaware County are not mild. If you're buying a short-term rental property, your revenue model needs to account for shoulder seasons. And liquidity is limited compared to suburban markets. This is a long horizon play. If you need to sell quickly, rural land does not move fast. Understand your timeline before you commit. This is not a get-rich-quick trade. It is a get-wealthy-slowly thesis. And I only believe in it because the data is pointing in one direction and has been pointing that way consistently for 3 years. Okay, I need the comments section on this one because I think there are 3 very different people watching right now. First, if you already own property in upstate New York or anywhere in the Hudson Valley or Catskills, tell me your county and whether you've seen the appreciation I'm describing. I want real numbers from people on the ground. Your data makes this research better for everyone. Second, if you're in the New York City metro area right now, grinding away, paying $3,500 a month for a one-bedroom, and you've genuinely thought about making a move, tell me what's holding you back. Because the gap between where you are and where this math says you could be is smaller than you think. Third, if this video gave you one new thing to research, one county, one zip code, one idea you hadn't considered, hit the like button. One tap, that's it. It tells us to make more of this kind of content, and it helps this land in front of people who need to see it.
Here's the principle behind everything we've covered in this series. Wealth doesn't announce itself. It moves quietly. Into the markets nobody's watching yet. Into the zip codes the headline writers haven't found. Into the states that are still under the radar. The people who win, they show up 2 years before the crowd. They do the research, they ignore the narrative, and they buy before it's obvious. That is what Finance with Franklin is built to help you do, every single week. Now, starting next week, we're shifting gears because we've spent 7 videos looking at where people and money are moving. Next week, we start looking at where money is dying. There's a major American retailer closing over 400 stores this year, and every news outlet is blaming the internet, Amazon, e-commerce, the death of retail. But that's not the real story. The real story is a debt-loading strategy that private equity firms used to extract billions from that company and left the employees, the landlords, and the pension holders holding an empty bag. That story starts next week. It's called Corporate Forensics, and it is going to change the way you look at every store closure, every bankruptcy headline, and every going out of business sale you ever see again. Subscribe, don't miss it. I'm Benjamin Franklin. This has been Finance with Franklin. See y'all next week.